Hey, what's going on, everybody? It is Wednesday, January 19th. Another big down day in the markets. Not big percentage-wise, but I thought we'd see a rebound today. The market sold off. We are still in support levels based on what I like to look at, which are dealer positions in the futures. But we got to see. The thing I want to talk about here really is what's going on with the fiscal situation, because that's starting to look a little tenuous, I have to say. Yesterday, well, let me just start off by saying the deficit so far for January, the monthly deficit for January, is down to a paltry 1.3 billion. So what we're 3/4 of the way through January. The deficit for the month is 1.3 billion. And if you extrapolate that out for 12 months, I mean, what? You're talking about a $15 billion deficit, when last year we had a $3 trillion deficit. Now, it's not going to be a $15 billion deficit. I mean, look, basically, for the month of January right now, the government's running a balanced budget. Now, a lot of people might be saying, yeah, that's a great thing. That's not a great thing. Remember the swimming pool analogy? I mean, that water now, I mean, you're not even like 6 inches or a foot below the top of the pool. You're down at the bottom of the pool. There's like no water left. There's like a little tiny sheet of water at the very bottom of the pool, and that's going to be, at this rate, it's going to go out fast. Where's the water? It's flowing to the government side, which means it goes nowhere. It disappears. Now, yesterday, the 18th, was a big tax day. The government took in $66 billion of taxes, so that kind of skewed the deficit. But even so, the trend is not, it's not a healthy trend. When you're talking about net transfers to the non-government, to the economy, like, that is shrinking fast. And that is just a reduction in the quantity of financial assets being transferred to the non-government, to the economy. I mean, it's, if you think about that as lubricant for the economy, right? Like lubricant for your car. If you got an oil leak and you're running that engine, that's going to seize up. That's a problem, man. That is a big problem. Now, I've been talking about there's an offset to this, which is bank credit. And we're kind of at a crossroads right now, I have to say. And let me preface this whole thing by saying that, this could be like a fundamental shift in the economic environment that we have been in now for a long time. Okay? And not in a good way. Now, I've been talking about bank credit and the expansion in bank credit, which is an offset to the shrinkage in the government deficit. And again, we're almost in budget balance. And by the way, you heard that here first. And when you read about that in the next couple of weeks, because that'll be reported that the January budget maybe was a surplus, and everyone's going to be going, yeah, and people are going to be patting Biden on the back, saying, look at the good job he made. And Jen Psaki, his spokesperson, will be going out there and saying, hey, we balanced the budget for Jen. It's not a good thing. It's not a good thing. So just remember, you heard that here first. A balanced budget is a reduction in the non-government's financial balances. It all flows to the government. And I've been talking about this, how the way things are set up, in a downturn, in an economic downturn, we have automatic stabilizers like Social Security and unemployment benefits and food stamps and Medicare and Medicaid. and veterans benefits and disability and all these things that kick in and they expand automatically as people lose their jobs and they, have to seek help from these programs. So that's like a safety net under the economy. But it works the inverse way as the economy grows. At some point, the tax collections start to exceed the flow of spending, right? That's that water pipe going into the pool. The water's going into the pool, but it's draining out a lot faster than it's going into the pool. And now it's draining out a lot faster than it's going into the pool. You got that little tiny sheet of water at the bottom of the pool, which that is about to go down the drain too. And what happens? The banks step in, they offer credit. One of my subscribers even told me that, Mike, anecdotally, I see that because I'm getting tons and tons of, new credit card offers in the mail and stuff like that. You might be seeing that too. I'm seeing it too. But the problem is that's only a temporary fix, if you want to call it that. Again, that's not the same as, getting a government check or something where the money you put in your pocket, it's yours. Your balance has gone up. There's no, offsetting liability to that. That's your money. I mean, a bank credit, there's only so far you can go. Now, I've been saying that debt service burdens, in other words, the difficulty or the ease of satisfying that monthly payment of your mortgage, of your insurance, of your rental costs, of this nature, that is at a pretty low level. I said that's about a 9% of disposable income. In 2007, it was at 13% of disposable income. But as someone said here, they put up a comment, and they're right, whoever that person was, they said that, those debt service burdens can rise quickly, especially now if the Fed is going to raise interest rates and if bank credit is expanding rapidly. So the ability of bank credit to sustain the economic expansion is limited. All right? It's limited. Whereas the government's ability to sustain it is only limited by the availability of real assets, real resources. Labor, natural resources, that sort of stuff. It's not financially limited, but it's limited in the sense of real assets. We could be I don't think we could be. We are at a crossroads right here. I think that bank credit will float the economy for a while, but unless this fiscal situation is addressed, and I don't know, politically, the Democrats are stymied, they can't pass anything. This economy could be in serious trouble, several months down the road, if not sooner, when the Fed starts hiking interest rates. We're looking at a problem here, folks. And I have to be honest, this developed very quickly. I didn't see this developing, at least the fiscal picture as it is, as rapidly as it did. But it's here. It is here. And, you either need a tax cut, you need an increase in spending, and we're not going to get any of those things, really. And I see politically where it's probably in the interest of the Republicans to trash the economy because, all the blame is going to go on Biden. They're going to blame him for inflation. They're going to blame him for recession. And, he deserves a lot of that blame, to be honest, because he didn't have the force to push things through. The Build Back Better would have been really, really helpful. He always wanted a compromise. You need a strong personality. You need a strong backer of the idea. If you have ideas, if you have policies, if you have proposals, you got to back those things strongly. You got to play hardball. You can't, be weak. The other side senses that. It's all politics. So that's where we are right now. And that has implications for all markets. I want to say one thing. You may be noticing that gold is rising in a rising interest rate environment. Bond yield's been going up. The Fed's been, spewing out hawkish rhetoric about rate hikes. The market's pricing in now 4 rate hikes for this year. Gold is going up. A lot of people would look at that. I think a lot of these gold bug people would look at that, and if they're honest, they would scratch their heads, because they always think like, hey, low interest rates are inflationary, and gold doesn't work that way. It's actually the way it's playing out right now is the right way. And once again, higher rates flow through to generally higher prices, and gold is responding to that. So this is the way it should play out, and it's playing out exactly the right way. Anyway, and I said this was going to happen. I told you that this was going to happen. So we are at a crossroads here. And to sum it up, the economic and particularly the fiscal environment that we have been under now for a long time. I can't even, basically I can go back and date this to 2009. We might have had some lulls in several years between 2009 and now, but certainly when Trump came into office, it was like it accelerated, and then with the pandemic, that was like pouring gasoline on the fire. But now the whole thing is rolling over. Federal government's going to be in surplus. It's a net drain on the financial balances of the non-government. You can't operate like that for an extended period of time. Bank credit will fill the void for a while. Household debt burdens will rise with rising interest rates and with the expansion of loans and debt and credit. And that's it. Then it's like a house of cards. So that's where we're at. Anyway, good talking to you. Please like the video and subscribe. Thank you very much. Bye.